welcome to the Adjusted for Risk podcast here from the shores of South Lake Tahoe. So let's go ahead and get started here and jump right into it. So the Fed obviously hiked rates by 75 basis points this week. And what was one of the more anticipated FOMC meetings in recent memory. The 75 basis point hike was the biggest hike since 1994, and it brought the Fed funds rate to a range of 1.5 to 1.75%. During his follow-up press conference, Fed Chairman Jerome Powell signaled that there's going to be more 75 basis point hikes to come potentially. Policymakers increase their expectations for the Fed's terminal rate or their peak Fed funds rate to 3.8% by the end of 2023, which is up from their previous forecast of 2.8%. The 3.8% is very close to what markets are forecasting also. So it's becoming clear that the Fed is going to have to inflict more pain in order to tame inflation. And this pain, I think, is going to result in a recession. And I'm not the only one that believes that a recession is looming due to the tighter monetary policies, tighter financial conditions. There's many people out there that believe we are on the course of a recession. The Fed is now forecasting GDP in 2022 to be 1.7%. And that's compared to their original projection or their March projection at 2.8%. They're also projecting the unemployment rate could rise to 4.1% at the end of 2024 from their previous projection of 3.6%. So in the meanwhile, you have the Federal Reserve Bank of Atlanta's GDP now forecast. It is now forecasting second quarter GDP to come in at 0. So it's not just talking heads out there who believe that we're on a crash course to a recession. There's a lot of other organizations in the Fed that have downgraded their economic growth, in large part due to the recession and the tighter financial conditions. And those financial conditions are going to tighten as we move forward and the Fed ratchets up their fight against inflation. At the expense of fighting inflation and repairing its credibility, the hawkish Fed is now more likely to cause a recession in 2023. And there are some numbers that show that that the economy is softening in parts of it. The housing market, for example, is really feeling the impact of higher rates as building permits and housing starts both fell in May, as mortgage rates now are at 6%. The impact of that steep climb in mortgage rates from 3% earlier this year to now 6% has a huge impact on mortgage payments. For example, Ben Carlson from Ritz-Holtz Asset Management tweeted this week that the mortgage payment on a $500,000 house with a 10% down payment was roughly $1,900. The monthly mortgage payment was $1,900 at 3%. Now, that same $1,900 monthly mortgage payment now only gets you a $340,000 house, compared to at the beginning of the year at $1,900 per month. You can roughly get a $500,000 house. You can see the huge impact that rising rate is going to impact the housing market, particularly mortgage rates. So in addition to the softening housing market, you have consumer spending. Earlier this week, we found out that consumer spending fell for the first time in 5 months. You have regional manufacturing indexes like the Philadelphia Fed and the Empire State Manufacturing Indexes, both contracted in June. They're negative territories in June. That doesn't paint a very good picture, considering the Fed is looking at raising rates nearly another 200 basis points this year, despite signs of weakness within parts of the economy. Now, while there's some signs of weakness, there's still some strength in solid numbers within the economy. And it starts with the labor market. While jobless claims have been inching up, the labor market remains tight and should give consumers some confidence there. However, as the Fed continues its aggressive tightening, the unemployment rate is likely to rise. And I think the tight labor market and the relatively healthy consumer will offset the recession pressures through 2022. I think the tight labor market and even those consumer spending is fallen. There's enough there to keep the economy afloat through the remainder of this year. But I do think we will have a recession as central banks around the world. It's not just the Fed. You have the Bank of England, the ECB, all these other central banks around the world. They're tightening policies. So financial conditions around the globe are starting to tighten, and that's going to have a negative impact on the global economy as well. And this is evidenced by global organizations like the IMF and World Bank. They've downgraded their economic growth forecasts for 2022 and 2023. So while I do believe we're headed towards a recession, equities performed quite well the last time the Fed was this aggressive in trying to fight inflation. If you look at during parts of between 1979 and 1982, equities rose 8%. And if you remember, during that time period, Fed chairman at the time, Paul Volcker, he hiked rates all the way up to 20% from 5% really during that time period. And it wasn't a gradual increase. It was really spiked up to 20% over a course of a couple months. He really, impacted, he put the economy into a recession in its fight against inflation. But despite 20% Fed funds rate, and despite this head-on fight against inflation, runaway inflation, equities rose at 8% during that time period. So there's some opportunities here. I still think it's too early to be jumping into equities. We're going to see some more weakness ahead, but as consumer sentiment declines, there's going to be some opportunities ahead to maybe jump in, but we're still way too early. On the fixed income side, I also think being patient is very important. While yields have jumped well above 3%, you're looking at 3.2%, which are getting to be very attractive. I still think it's a little bit too early. Recession is looming, say 2023, so more investors will be turning to safe havens like treasuries, but I still think it's a little too early there to be jumping in. So with that, I think, again, as I've been saying a lot, in these volatile markets, look to high quality companies with solid cash flow, play defense, but don't make any huge wagers. Focus on the longer term, focus on the big picture investment objectives, and just stay patient. So with that, let's move along to segment number 2 and staying sharp. So ESG investing has been in the headlines a lot lately, and they really haven't been great headlines. Years ago, over the past really 5-7 years, ESG headlines, they've been capturing a lot of headlines, but they've been good headlines. Performance was good. A lot of people interested in doing good by the environment and interested in sustainable investing. But that's really turned really over the past, I'd say 6 to 8 months. Those headlines that ESG have been part of, they haven't really been great headlines. And whether it's about asset managers being accused of greenwashing, or the issues with the lack of standards on third-party ratings, or from people who are saying it is a politically charged investment style. Bloomberg came out with a really great piece this week laying out the challenges ESG investing faces. I've done a lot of research on this topic, and it can be a polarizing topic, as some have made it political, while some believe it is a marketing gimmick, and that's evidenced by greenwashing. And while some, like Elon Musk, who's a huge influencer in the investment space, think ratings are a joke. So really, here's my thought on ESG and some of the obstacles ESG investing faces that was outlined in that Bloomberg article. There's no hiding it. There are definitely some headwinds, and some of the concerns are warranted, such as the lack of ESG standards and no streamlined disclosure languages that are included in a company's financials. But because of these lack of standards and the fact that everyone has unique views on what ESG means to them, what ESG means to me, or what's important to me, is completely different than what is important to all of you. It is important to understand, if you're a financial advisor or a fiduciary, it's very important to understand those unique views of your clients or your investors, and understand what tools, data, investment vehicles can be used to better help align investor views with their investments. In most cases, you cannot simply use an ESG ETF and expect the investments to align with your client's values and beliefs. There is no one size fits all product out there. For example, through a lot of my research I've done, Facebook is a top holding in many of these strategies. Some of the largest ESG strategies out there, Facebook is a top 10 holding. However, many of you may not want to hold Facebook for numerous reasons, like them owning Instagram, which has really been proven to cause harm to teenage girls' self-esteem. So also, there's some ESG ETFs that look a lot like the broad S&P 500 SPDR ETF due to their overweights in technology, while also being more expensive than the SPDR ETF. These SPDR ETFs, which is really driven the performance of these ESG funds, or the overweight, high exposure to the technology, has really driven the performance of these ESG funds. Whether that's outperformance or underperformance. When technology was doing very well during the pandemic and shortly after the pandemic, ESG funds were also doing very well. Well, now ESG funds have struggled recently as that popular tech trade is unwound. That SPDR ETF is also very competitive in terms of ESG ratings, whether that is in aggregate ratings or more granular thematic ratings compared to ESG ETFs. So it's very important. You just can't pick an ESG fund and assume that you're doing right by your client and meeting your values. So it's very important to look under the hood of these ESG products to make sure they are indeed investing in companies that align with your client's beliefs. with that, I think leveraging, direct indexing or separately managed accounts is really the best way to gain access to ESG investing, because you can customize those products based on your clients' views. There's a lot of headwinds out there, but if you have clients that are really interested in investing in their values, their morals, their beliefs, and want to include ESG or some type of ESG or a thematic investing in their client portfolios, leverage those tools, leverage ratings, look at DNA reports that really get down into the holdings, and focus on products that provide your clients with some ability to customize the investment. So with that, let's move to Nauman's musings. So it's Father's Day weekend. I'm a father, as you know, or many of you may know. It is, to me, such an honor and a privilege to be called dad. I can't tell you how much I really enjoy it. But with that being said, I cannot think of a greater responsibility than being a dad. There is really nothing better than when your son or daughter comes up to you and says, "Hey, Dad, will you play with me?" Or, "Can we go do something? Can you help me?" Or really looks up to you as a role model or somebody that helps you, or they feel safe around you. It's the greatest privilege or responsibility I think one can have, and I just really, really enjoy it. But my dad, I consider as the best dad anyone could have, is no longer with us, so I won't be celebrating with him this weekend. But my son Oliver and I will be doing something. It's going to be cold this weekend in Tahoe, so I don't know if we'll be going to the beach, but we'll be doing something, and I for sure will not be taking it for granted, and I'm going to cherish every moment of it. And I hope other dads do that same thing. Don't take it for granted. It's a fantastic opportunity and such a amazing responsibility that you should all feel privileged to have. So I wish all you dads out there a very happy Father's Day. Have a safe weekend and have a great upcoming week. Thank you so much. And just a reminder, you can catch all the other episodes of Adjusted for Risk on our Adjusted for Risk YouTube channel. You can also read all of our insights about the Fed, about active versus passive, about ESG investing on our A Wealth of Insights from 6,237 feet website. And be sure to like, share, link any articles, and also reach out if you have any questions or comments. Please reach out to us, and we can go ahead and answer those questions. Or if you have any guests that you think would be fantastic to be on the show, please reach out. So with that, I'm going to sign off. I think that's a great spot to end, and I hope the rest of your week is a great one, and we'll see you next week. Thank you very much.